Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve is staring down one of its most complex policy decisions in years, and markets are repricing across the board. We're talking diverging inflation signals, a stubbornly strong labor market, and a divided FOMC that's creating whiplash conditions for traders. Let's break down what's moving right now and how to position for the March decision. Start with the inflation picture, because this is where the confusion begins. Headline CPI for January 2026 came in at 2.4%, down from 2.7% in late 2025. That looks good on paper. But core personal consumption expenditures, the Fed's preferred gauge, tells a different story. According to the FOMC minutes from the January 27 to 28 meeting, Fed staff estimated core PCE inflation hovering around 3% in December. That's still a full percentage point above the Fed's 2% target. This divergence matters. Headline inflation cooling gives doves ammunition to argue for cuts. Core PCE stuck at 3% gives hawks reason to hold tight. The persistence in housing and services sectors is what's keeping that core number elevated, and it's proving remarkably resistant to the monetary tightening we've already seen. Markets are caught between these two narratives, and that's fueling the volatility we're seeing across asset classes. Now layer in the labor market. January unemployment held at 4.3% with payroll growth around 130,000 jobs. That's resilient enough to support consumer spending, but not so hot that it screams overheating. According to St. Louis Fed economist Fernando M. Martin's analysis published March 3rd, titled Dual Mandate in Conflict, the Fed is facing mounting pressure as price stability and full employment objectives are pulling in opposite directions. This dual mandate tension is real. If you lean too hard into fighting inflation with restrictive policy, you risk breaking the labor market. If you cut too early worried about employment, you risk reigniting inflation expectations. The Fed is threading a needle, and the FOMC minutes make clear the committee is divided on which risk dominates. Current policy sits in the 3.5 to 3.75% range after the January hold. The minutes emphasize further adjustments depend on incoming data, which is Fed speak for, we have no idea what we're doing next. That uncertainty is bleeding into positioning across bonds, equities, and crypto. Fixed income markets are pricing this confusion in real time. The 10-year Treasury yield is sitting around 4.25%. The 2-year is near 3.57%. That curve configuration tells you markets expect cuts eventually, but there's zero consensus on timing. Some traders are pricing 1 to 2 25 basis point cuts over the coming months. Others think the Fed waits until June or later. Institutional disagreement mirrors this divide. Goldman Sachs and Morgan Stanley lean dovish, forecasting cuts later in the year starting around June. They're betting economic cooling forces the Fed's hand. Citigroup and Wells Fargo are in the hawkish camp, forecasting a March cut and arguing the Fed should act preemptively to prevent growth deceleration. When the big banks can't agree, you know volatility is the only certainty. Add another layer of complexity with the Kevin Warsh nomination as the new Fed chair. Leadership transitions introduce uncertainty around communication policy and forward guidance. Markets hate uncertainty, and this potential shift is keeping traders on edge about both tone and substance of future Fed messaging. Equity markets are reacting with sector-specific volatility. Consumer discretionary and technology stocks are the most rate-sensitive, and they're showing it. Every data point that shifts rate expectations creates rotation pressure. If core inflation stays sticky and the Fed holds, growth stocks get hit. If the Fed cuts preemptively, you get a relief rally in high-duration names. The problem is nobody knows which scenario plays out, so we're seeing choppy, headline-driven action. Crypto is amplifying this volatility as usual. The asset class has a history of exaggerated moves around FOMC announcements, and current conditions suggest March will be no different. Crypto reflects broader risk sentiment, and with monetary policy uncertainty running high, expect heightened volatility in Bitcoin, Ethereum, and the broader digital asset space around the decision. Let's talk about the repricing process happening right now. This isn't just bonds adjusting yield expectations. It's simultaneous recalibration across equities, currencies, and commodities. Bond markets are digesting inflation versus employment data. Equity markets are rotating based on rate sensitivity. Currency markets are factoring in relative monetary policy between the Fed and other central banks. Commodities are responding to both inflation concerns and growth expectations. The key benchmarks traders are watching include core PCE staying above 2.8%, monthly employment growth maintaining that 130,000 job pace, Treasury yield curve positioning, and sector rotation patterns in equities. These are the real-time signals that tell you how markets are leaning into the March decision. Now let's game out the scenarios. Scenario 1, the Fed holds rates and cites persistent core inflation. This strengthens the dollar, pressures growth-sensitive sectors, and likely triggers a risk-off move in crypto. Scenario 2, the Fed cuts 25 basis points, signaling concern about economic cooling. This boosts risk assets, weakens the dollar, and could reignite inflation expectations if the market thinks the Fed is panicking. Scenario 3, the Fed holds but signals potential increases if inflation doesn't moderate. That's your hawkish hold, and it creates maximum volatility because it keeps all options on the table. Each scenario has distinct implications for positioning. A policy hold favors defensives and value over growth. A cut favors high-duration assets and risk-on trades. A hawkish hold creates chop and forces traders into shorter time horizons. The broader context matters too. This isn't happening in a vacuum. Government spending patterns, deficit implications, and international central bank coordination all feed into the repricing. Global trade dynamics and geopolitical factors are adding layers of complexity that make the Fed's job even harder. According to analysis from J.P. Morgan, published in their Insights section, the Fed is navigating softer inflation data against the backdrop of employment strength, and that tension is the defining feature of the current cycle. Forbes coverage on March 5th noted that what to watch for from the Fed's March decision includes not just the rate decision itself, but the dot plot, the economic projections, and Chair Powell's press conference tone. Those are the signals that move markets beyond the headline decision. CNBC reporting on the February 18th release of the January FOMC minutes highlighted that Fed officials were split on where interest rates should go, with some participants advocating for patient policy and others expressing concern about downside risks to employment. That split is the reason we're seeing this repricing volatility. For traders, the actionable takeaway is this: position for volatility, not direction. The uncertainty is too high to make binary bets. Focus on managing risk, using options, strategies to define downside, and staying nimble. Sectors with pricing power and defensive characteristics look attractive if the Fed stays hawkish. High-duration growth in crypto could rip if the Fed pivots dovish. The key is having exposure to both scenarios without overcommitting to either. Watch the data releases leading into the March meeting. Any surprise in core PCE, employment, or consumer spending shifts the probabilities. Pay attention to Fed speak from officials between now and the blackout period. Hawkish comments from voting members move the needle. And monitor yield curve dynamics, especially the 2-year versus 10-year spread. Steepening suggests cut expectations are rising. Flattening or inversion suggests the market thinks the Fed stays tight. The repricing process is ongoing, and it won't resolve cleanly until we get more clarity on whether inflation is actually returning to target or if we're stuck in a higher-for-longer regime. The Fed's dual mandate conflict means they're reacting to data in real time, which makes forward guidance less reliable than usual. As of today, March 6, 2026, markets are in wait-and-see mode with elevated volatility. The divergence between headline CPI at 2.4% and core PCE near 3% defines the policy debate. Employment at 4.3% unemployment keeps the dual mandate tension alive. An institutional disagreement on cuts reflects the genuine uncertainty facing the FOMC. This environment demands careful attention to incoming data and Fed communication. The March decision will provide crucial guidance, but don't expect the volatility to disappear overnight. Until inflation trends become clearer and the Fed signals a confident path forward, we're trading in a repricing regime where flexibility, and risk management outweigh conviction trades. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.